payment and low down payment tips, where to come up with down payment, just down payment in general. Now, of course, certainly most people, if they own a home already, they probably are anticipating, well, I'm going to have down payment from when I sell my current home. And generally that is certainly true, though there could be exceptions where that might not be true if they're intending to buy the next house before they sell their current. And that's a whole other webinar that I do and topic that we discuss. So we're predominantly going to focus today on what we would maybe say is typically the first-time home buyer. They don't necessarily have to be, but they're really looking for some low down payment scenarios and options, and that is great. There are many different options available for those buyers today. So let me just get going. And first of all, I want to hit one thing right away. Some people think that in order to buy a home, and I hear this even today, they think you have to do 20% down to buy a home. Totally untrue. That is totally untrue. Well, certainly it's great if you have 20% down, but many people, even if they have the 20% down, do not do 20% down. And some people hear that and they go, wow, why would you do that? Well, because as soon as they put that money in, it's kind of trapped. Yeah, maybe that made their mortgage payment a little bit lower, but they then forego what that money could be doing for them elsewhere in some investment accounts or in their retirement account or whatever it is. So every situation is different, but let me address, first of all, many people do not do 20% down and they buy homes, especially their first time home. Okay. They're just getting going. And here's the beauty. When they buy a house, that loan balance will gradually fall. The home value will typically gradually appreciate. And then maybe in 5, 6, 7 years, they decide to sell it and they're going to get that equity in the home. And I'll show you an example of that here in just a little bit. Okay. So some loan programs, there are some loan programs that automatically allow for zero down. Most notably, that would be a VA loan or Veterans Administration loan. It is a classic example of that. Obviously, one of the borrowers does need to be a veteran in order to do that kind of loan. It's a great loan program. There's no monthly mortgage insurance on them. That is one of the benefits that our country provides to those who have served our country. So what a blessing that is available to them. And let me also say, for veterans, sometimes that is something that veterans do, but sometimes it's not. There can be sometimes that's just not a program they really want to take advantage of, and there's different reasons for that. And we walk clients through that, but it is a source for zero down. Another one is USDA loans. USDA. I say that and often people go, wait a minute, I think I see that in the grocery store. You do. United States Department of Agriculture. And so we think of them, they're like the ones that decide is a steak, is it choice, chuck, ground, well, not ground, is it prime? They grade our meat and our milk and some of the things that we eat. So yes, that is one of the functions they do, but there is actually a loan program through USDA. It is only though for homes in certain geographical areas. We would consider those to be more rural areas, R-U-R-A-L. I always think that's a weird word to say, rural. But in fact, let me see if I can show you a map. It's kind of an interesting map to show. Give me 2 seconds to get there. So sorry. Here's what I wanted. It was beneath it. There we go. No wonder I couldn't see it. Okay. So I'll show this map. And this is public access. Anybody could get to this site. So let me just screen share here for a minute. Here we go. You could do a Google search for this, USDA eligibility map, something like that. It won't take you long to find it. You have to click on a little accept or decline on some disclaimer. And you can put in a very specific address. I've not done it in that way at this time. I put it in for more of a geographical area. And I'll kind of hone in on, I'm in Dallas. I do loans in many, many states, but of course, a lot of the loans I do are in Texas. But we certainly lend in, gosh, I bet there's about 30 states we lend in. But let me just kind of use this as an example. So if you see that kind of slightly more, what do we call it, salmon, darker yellow area, those are areas where you cannot do a USDA loan, but outside of that, you can. Okay. So here in the Dallas area, that just pretty much means more of the outskirts. Okay. Those are areas where a USDA loan is probably possible to be done. And it's a pretty good program. I've had some clients do that. Obviously, it does mean they have to kind of be out there more in the country, but that is one option for zero down. So something to consider. Again, a great little fun map. If that's something that interests you, and you may not go, wow, that would be too far of a commute for me. Hey, I get it. That's fine. Don't worry about it. There's other options, but for some people, that is a viable option. Let me stop sharing here. There we go. Okay, let's keep trucking. I should also point out that those programs, and really all of the programs we're talking about today with very little down or low down, are on the assumption it's going to be a primary home. It's going to be a home that you are going to live in as your primary residence. Now, by the way, that doesn't mean it has to be your forever home. Let's say you lived there for a couple of years and then you moved and bought another home and you decided to keep this one as a rental property. That's okay. You can totally do that. Nothing wrong. What you're going to be signing at closing is something that says, this is my primary residence. I intend to live here for at least a year. The key word there is intention. Okay. Now, it would be definitely considered mortgage fraud if somebody were to buy a home and immediately turn it into a rental property. You could get in a lot of trouble for that. Okay. By the way, the reason for that is because homes that are investment property, purchases only, or second homes like a vacation home, have higher rates. They require more down payment. It's a whole different thing. Okay. You don't want to mess with that. So, but as long as you intend to live there for a year or more, you're fine in considering your primary residence and you move into it. Now, let's just say, and I've actually had this happen to a client. Let's say you bought a home and in 6 months, your company said, hey, we need you to go to Denver. We need to relocate you. Okay. And you decide to go and be relocated. And then maybe you said, wow, I don't want to sell my house because what if I wanted to come back to Texas? That's okay. You could begin to rent out your home. You haven't done anything wrong. Your intention was to live there, primary residence, for a year or more. You didn't know you were going to get relocated. You've not done anything wrong. If it was ever questioned, you could easily validate that information. Okay. Another thing that comes up a fair amount, and by the way, I would say there's more talk about this than there is actually doing it. It's called down payment assistance programs, or DPA for short, down payment assistance. There are a lot of variations of various DPA programs out there, and we offer many, many, many of them. Okay. I could do a 3 or 4 hour webinar just on DPA programs alone and bore you to tears with all the details of those different variations. I'm going to just give a summary of some things that you should know. This is what I tell clients when they ask about them. Let me say, there is absolutely a time and a place for DPA. There sure is. It is not the first place that I go. And the reason, and some people go, why not? It's free money. It ain't free. Ain't nothing free. Okay. There's some strings, and the strings aren't so positive. So if there's a way to help a client buy a home and not have to do DPA, I know they get a better loan in the end. Okay. Now, some people hear that and they go, but yes, if it helped out with a down payment, wouldn't I be borrowing less? You would. You would. That's true. However, what happens is when DPA is used, it typically, not always, is typically done in coordination with an FHA loan, but in some cases conventional. The interest rate is higher on that mortgage. It has nothing to do with that particular borrower. It is simply, unfortunately, a classification that loans, it's statistically proven, loans with DPA, unfortunately, have a little bit higher default rate. Now, I didn't say they all go into default. I didn't say they all go into foreclosure, but that preponderance is a little bit higher. In other words, it's a little bit riskier loan. So how do they reflect that risk? A little bit higher rate and mortgage insurance that's not as inexpensive. Okay. So it's something we certainly can look at, but I will tell you, they always end up with a higher payment if they do that. They will have a lower payment if we can avoid it. Okay. So I don't say we don't do them. I just say it's not the first thing I go to. I go to other things first. I am also fully aware that there are some mortgage lenders out there that just sell the positives of DPA all over the place because it's shiny. It looks good. It sounds great. The devil's in the details. Okay. Certainly, it's something we look at, but if we can get them a better option first, that's what we go to. Okay. By the way, you may hear the terms grant program or a bond program. Those are often used in just the umbrella of DPA, down payment assistance. Okay. Let's see here. Some DPA programs have I would call it a tail on them. Sometimes if you sold the home within a certain period of time, you must repay the amount of assistance that was given. Sometimes it's forgiven. There's a whole different variations. And wow, again, a lot of rabbit trails we could go down there, but just know it ain't that simple. It's not just free money. There are details that we have to explain and go into. The other thing that's important to know is they do take longer to close. They just simply do. There's a lot more scrutiny of those loans. And so it takes longer from contract to closing. And with some homes, if it's competitive for that home, that just may knock it out of competition. Okay. So it's just an unfortunate fact. But again, it's one of the things we look at, but it's not the first thing we look at. Let's see here. Other notes on DPA. By the way, I should note this. When a client uses a VA loan or a USDA loan, those actually, even though, yes, they are zero down, they don't have those negative connotations. The rates on those programs are actually very good. Okay. So those are actually really good programs. And that's not considered down payment assistance. Okay. FHA loans. A lot of people think FHA loans, Federal Housing Administration, is only for first-time home buyers. That is not the case. They can be used whether it's your third home or fourth home. I will understand that many times it is a first-time home buyer, but not necessarily. And by the way, there are many first-time home buyers who do a conventional loan. I'll explain that in a minute. FHA loans, good program. They allow for 3.5% down payment. That's the minimum down payment for an FHA loan. However, the mortgage insurance on them, when 3.5% down is done, that mortgage insurance does last the life of the loan. It's kind of a negative of it. And the mortgage insurance in many cases is a little bit more expensive. So again, something we look at. By the way, that can be a better program if someone's credit scores are not at the top end. Maybe they're kind of mid-range. Maybe FHA is actually the better loan program for them. Okay, that's one of the things we look at, case-by-case basis. So again, positives of FHA, but that mortgage insurance is there for the life of the loan. Of course, let me say, if in 3 years, 4 years, whenever, if we saw interest rates dip, you can still refinance an FHA loan. Totally. That's totally fine. And maybe refinance it off of an FHA loan. And then maybe the mortgage insurance would fall off altogether. Depends on the situation and how much equity had built up through the appreciation and through the principal reductions. Okay. Equity is simply the difference between what a home is worth and what you owe on it. And over time, generally the home value rises, the loan balance gradually falls, and the difference is equity. That's what you own if you sold the home, that's your equity position. Okay. Conventional loans. You may have heard the terms Fannie Mae or Freddie Mac. And wow, again, we could probably do a 3 or a 4-hour webinar on Fannie Mae and Freddie Mac. You would probably be bored to tears largely. Here's what I tell clients, what you're going to hear that term. Here's really what you need to know for the basics. For the layman out there, Fannie Mae and Freddie Mac are like the governing body of lending land. They make the big rules. You want to follow those rules because they have really great rates and really great options. Okay. That's the simplistics of it. FHA and VA are just another variation of that. Okay. So conventional loans, you could do as little as 3% down. 3% down. So it's a little less. Also, many cases, not always, the mortgage insurance may be a little less expensive on a Fannie Mae or Freddie Mac loan, and it can fall off faster than on an FHA loan. So there are some perks. Generally, when I have a client needing, let's say that they don't qualify for VA, they're not going to buy in an area where USDA would work. I then go to my kind of pecking order is then we talk about conventional loans, see if that works good for them. And then we then go to FHA, and then maybe we go to down payment assistance. So that's kind of the order in which I typically follow. There certainly are exceptions. Also, a note about mortgage insurance or PMI. When I bring that up, a lot of times the feeling, and I can just sense it when I'm talking to clients, they're like, ugh, I got mortgage insurance. Like it's a big negative. Well, I'm not asking people to love mortgage insurance, also called PMI, which is private mortgage insurance, because a lot of people go, it doesn't do anything for me. That's a way to look at it. Let me explain what mortgage insurance is. This helps a lot. So it is something that provides an insurance policy that in the event, worst case happened, that if, heaven forbid, and nobody wants this to happen, the home had to be foreclosed upon, there's an insurance policy that helps to fill the gap of what is owed on that loan and getting that property sold and being able to pay off that loan. Okay. So mortgage insurance gets less expensive as the borrower does more down payment. And when they do 20% down, it goes away altogether. Also, if a borrower has better credit scores, mortgage insurance is less expensive. Okay. So there's a lot of things in there that can make mortgage insurance not that bad. And here's the other thing. As you on a conventional loan, if you pay extra, you pay further down on the mortgage, you could eventually get it where that would fall off. Okay. Might even be able to, at some point, ask for an appraisal to be done. And if it showed you had the appropriate amount of equity, that mortgage insurance might fall off. The biggest thing to understand is if I took 100 people off the street and I said, hey, what do you think about mortgage insurance? I know I would get a resounding, I don't like it. It's not great. I get it. I'm not trying to dispel that. I'm not trying to fix everything out there in America. But if you think about it, if that, you know that lets you buy a home with less than 20% down, and that without that, you would have to do 20% down, that's a big deal. And think about it. On, let's say, a $500,000 house, 20% down is $100,000. On a $300,000 house, it's $60,000. Okay. Whereas, let's say that $300,000 house, if you could do just 3% down, that's $9,000. Wow. That's a big difference. $9,000 or $60,000. Okay. So it helps many, many Americans buy homes and enjoy homeownership without having to save up, because it would take a long time for most people to save up 20% down. Okay. Something to think about with mortgage insurance. Also, it is important that I mention that, yes, there is down payment. There's also this thing called closing costs. Sorry to say it. I wish it wasn't so, but closing costs are a reality. Now, this is the difficult part. One of the difficult parts of my job is it seems like a very common question people would ask me. Hey, what are my closing costs going to be? What a great question. And you would think I could be able to just go, oh, well, you're going to buy a house about $400,000. It'll be about this amount. It's not that simple. There are a lot of different decisions that get made and decisions that are set up in the contract that can vary that number quite a bit. It depends on who's going to pay for the title policy, who's going to pay for survey, what is the cost of the insurance? Are there HOA dues? Is the insurance less because there's HOA dues? What are the property taxes? There's a lot of different parts that make up closing costs. Okay, so title company fees, property taxes, home insurance, and yes, there's some lender fees. There's also some choices that borrowers get to make. There are decisions that they'll get to make that can make their closing costs a little less or make their closing costs a little more. And I know when I say that, I kind of tease clients and I go, Well, you hear that and you go, I choose for them to be less. I understand. However, you need to understand the bigger picture is, I'll simplify it a lot. When closing costs are less and you choose for them to be less, your interest rate's a little higher. When you elect for them to be a little bit more, your payment's a little bit lower. Your interest rate's lower. It's an inverse relationship. Closing costs go up, your payment can go down some. No, I'm not saying it's going to fall to zero, but you get a little bit of choice. And we walk through clients through that. We talk about something called payback analysis. We walk that through when a client goes under contract and we get into those details. But we can always give them some, broad brushstrokes about closing costs. The reality is they are going to be there. Here's the other important thing to note. Many times, not all the time, but you may be able to negotiate for the seller to pay some or maybe even all of the closing costs. It depends on the situation. I cannot guarantee that, but I've had quite a few closings where the buyer is only bringing their down payment and they're not paying any of the closing costs. It just depends on the situation. Again, happy to talk with you about that, schedule more time about your specific situation. But that same thing could happen even if they did a USDA or a VA loan. I've had clients buy those and bring nothing to closing. Okay. But yes, closing costs are a reality. Let's talk about where people get down payment money from. Now, I realize that some of these are super obvious, and you'll be like, yeah, I get that. Of course, checking accounts, savings accounts. Maybe they have a CD, a mutual fund, stocks, bonds. Those are just some of the more common ones. Maybe they have a life insurance that has a cash value. That's more of typically a whole life policy. A lot of life insurance policies do not have that, but there's some that do. Maybe you have a retirement account, a 401k or an IRA or a 403b. There are some interesting things to note here for first-time home buyers. A first-time home buyer can take up to $10,000 from their retirement account without paying the early penalty withdrawal. Well, that's a nice little benefit. Okay, you can only do it once, only as a first-time home buyer, and it can't go over $10,000. Another option some clients do is they can do a loan against their retirement account. Okay, typically a 401k or a 403b, that's typically through their employer. And generally, there certainly are exceptions. The rule is they can borrow up to half the value of the account, not to exceed $50,000. So if they had $20,000 in their retirement account, okay, they could borrow up to $10,000, half the value of the account. If they had $150,000 in there, half of that would be $75,000. They couldn't get a loan for $75,000, but they could go up to $50,000. And then they just pay back. The money they're paying back is not counted against their debt ratio. They're basically paying themselves back. Okay, so just through some payroll withholdings, there's different ways it's done, but it's paid back. Okay. And usually when that money is used for the purpose of home buying, they often give you a 10-year payback time. So that's not necessarily the first place you go. I realize that money is set aside for retirement, so we want to be conscious of that, but it is a place you could maybe get some money from if you needed to, or maybe a little bit if you needed extra. Yes, in some cases, this doesn't apply to many people, but I've had some clients who had a trust that been set up for them. Maybe when they were kids, their grandparents or great-grandparents set up a trust. Maybe that's a source that could be tapped. Maybe it's a trust that is not accessible to them until they're age 35 or 40, but maybe there's a case in which the person that manages the trust would let them take some in advance. Liquidating an asset. You got to be careful with this. And I'll admit, just selling various random pieces of furniture probably isn't going to really generate enough, but maybe you have a car or a boat or an RV, a recreational vehicle, whatever it is. And you go, I don't use it anymore. I'm going to sell that asset. Now, you do need to keep documentation of it. I'll explain more about sourcing funds here in a little bit, but that is a place I've actually had people do that and come up with funny money for down payment. Let me talk on cars for just a moment. Let's say that you're a couple, you each have a car, and you go, oh yeah, we're going to sell a car, and use that for down payment. Well, yes, you could technically do that. Underwriting is not stupid. They realize that unless you have a really compelling storyline to that, the concern that underwriting is often going to have is, hey, they're going to sell that car, use that money for down payment, and then they're going to have to go buy another car. Okay. So is that going to mess up their debt ratios? Now, sometimes people have a car that they paid off, or they have a lot of equity in that car, and they might want to sell it and get the money from that. And they can buy another car, and that new car payment isn't going to mess them up. I've had people do that. They just happen to own the car free and clear. I have a client that's going to close later this week, actually, who sold a car that they inherited from a grandmother. Okay. And they had 3 cars. Well, they sold that 3rd car and they were able to use that money to help them in home buying. What a great blessing that was for them. Okay. Again, boat, that's pretty easy. Most underwriters go, you probably don't have to have a boat. I guess if you lived along the coast and you were a fisherman, okay, maybe that's a different story. But aside from that, it's probably not a situation you need to be aware of. It is important to keep documentation of it, a bill of sale. What did you sell? What was the VIN number? And it's important you document that, maybe a cashier's check. Or however you do it, but be sure that whatever you sold it for, that you deposit that exact same amount into your bank account, ideally through a cashier's check or some other really, documented form of money. Okay, that'll be needed for underwriting. Let's see here. Gift funds from family. We see this a lot. I would venture to say we probably see this here in the DFW, Texas area 30 to 40% of the time. It's a lot. Now, every family is different, making no judgment calls here, but we do see this quite a bit where that first-time home buyer, they've got some money, but it would sure help out. Maybe family is going to say, hey, we'll help out with $5,000 or $10,000. And I've seen all kinds of different things. I've seen as little as $2,000 or $3,000, and I've seen hundreds of thousands. Okay. Obviously, every family is different. Different situations, no judgment made there whatsoever. But that is a valid source of funds for home buying. It is important that we document that. I usually provide more information on that specifically when I know that a client is going to do that. And I do try to make sure I ask, because there's a very specific way that that money should be given to them that is for the benefit of them as the recipient as well as the donor. Usually, there are exceptions, but typically what we advise is that the donor, which is usually a parent, grandparent, uncle, aunt, something like that, wire the money to the title company where the closing is going to take place, maybe just about a week before closing, maybe 2 weeks before closing. I do not recommend that they write a check to the recipient, it's typically the home buyer, and then that they deposit the check. While I can't stop them from writing you a check, I will pretty much promise you they wish they would have done it the other way. We can make things simpler for them. We document it with a very standardized gift letter. All lenders use it. It's a 1-page letter. It effectively says, hey, we are giving this amount of money. It says the amount of the money, who's the donor, what's their name, what's their relationship, email, phone number, the recipient's name, phone number, email, and it's for the purpose of buying a home or home purchase, and that there's no demand or expectation of repayment. By the way, I am fully aware that many family arrangements may decide that they're going to repay it later down the road, but that's a family decision. How that works. Maybe it's going to be when they sell the home. You name it, I've heard it. Okay, but they're not really setting up a loan per se. Okay, so gift funds from family, a very common thing. Family is a pretty nebulous concept as well. I can certainly tell more on that if you need more specifics. This concept of sourcing money is very important. In America, you can't just have money come out of nowhere. Okay, if we have to typically show 2 months of bank statements, and if they saw, they always know you're going to get payroll deposits. You're going to have various checks and things that you deposit into your account. But if there was a deposit of $15,000 that came out of nowhere, just a random cash, underwriting is going to ask about that. Why is that? Well, two primary reasons, and one of them is kind of slightly silly, but They have to prove that that money was not borrowed, okay? That it's not messing up your debt ratios, okay? So that's number one. Number two is, and I know this often sounds silly, but you're not money laundering, okay? I don't think you are, but that's the other reason is just in America, home buying, they want to make sure they know where the money came from. It came from a valid source, okay? So that's sourcing of money, a very common thing we need to be aware of. I will mention one other little caveat here. In some cases, I've had clients who buy a home from a family member. Maybe they buy grandma's house or grandpa's house or another family member's. This can really create some very interesting opportunities where there can be something called a gift of equity. Gift of equity. This doesn't apply in all situations, but when it does, it really does a neat thing. Many times when I am helping a family and they've got usually a younger family member wanting to buy their grandparents' home or parents' home, whatever it is, well, they're usually not trying to get top dollar. They might be, I'm sure there's exceptions. They have a certain amount of money in mind, but they kind of usually are going, hey, if we could sell this to you, keep it in the family, we would sell it for X price. Although that price is usually low. Okay. What a blessing for that home buyer. So usually when I'm talking to this, they say, oh yeah, they'll sell it to me for $300,000 or whatever it is. Maybe it's worth 400. Well, what I may say, and this depends on the situation, I'll run some math. I'll say, hey, I know this is going to sound weird, but what if you sold it to them for 350? They said they would sell it for 300. What if you sold it to them for 350 and did a gift of equity of $50,000 and that became their down payment? In other words, we transfer that equity that the seller has in the home to the buyer. And then the buyer doesn't have to do a down payment, doesn't have to do any closing costs. It can be a huge blessing. I've seen plenty of those happen where that buyer brings nothing at all to the table. It was all done through a gift of equity to cover the closing costs and the down payment. Again, not every situation works that way, but that is one option when it comes to down payment. Those are a couple of ideas. Again, this is not meant to hit every potential option. Obviously, I touched on DPA, down payment assistance. And again, that is a whole other creature that really is very specific. It depends on what's the best fit. Some of them are only for certain cities, only certain states, certain counties. Really have to, there's just no way to cover all of those. So usually what I do is I just talk to the client, kind of find out what their needs are. And if we need to talk down payment assistance, we'll do that. Other than that, it's something we set off to the side. Hey, I hope you find this helpful. If I can answer any questions at all, again, feel free. My contact info is right there. Reach out to me. You'll also see we have other training sessions coming up, and then we'll be doing more in 2024, which is not far away. Have a great day. Bye.